Good afternoon, welcome to the APW Market Wrap for week ending the 7th, I think it is, of January 2022. Stuart Williamson here at the helm. Why do we do this? Just to spread hopefully good information around the marketplace. I got a bit of flack last week about just talking about what the pundits are saying who are trying to talk the markets up. So I thought this week we'd do something more exciting, potentially, and talk about if you're doing New Year's resolutions, where is it best to put your money? 50k into a property or 50k into the stocks and shares? Until recently, regulatory changes, red tape, tax changes such as the abolition of MIRAS and the like meant that it wasn't deemed so good to be in buy-to-let. It hasn't affected us so much offshore because we still get some good tax breaks, and also using SPV is a good idea. So I think MIRAS is gone, but you can get MIRAS still through a company. Things have changed recently. Rents have really started to increase. In July 2021, the north, the east of England, the southwest and the southeast all recorded double-digit growth in rents. Nationally, according to Hampton's estate agents, rents rose by 6.2% compared to the same month last year. This is a survey just did last week. But obviously buying and renting a property can seem like quite an enormous task. Could be quite frightening. So would it be therefore just a lot easier just to bang it into the stock market? So that's what we're going to look at. Is it better to go into the stock market? Is it better to buy a property, a buy-to-let? We're going to look at companies' shares over a 10-year period to do that calculation. But first of all, we're going to look at property. Rising house prices mean that £50,000 isn't going to buy you an awful lot, so you have to be very careful where you do buy. Locations such as South Yorkshire, Leeds, Hull, outer areas of Manchester, parts of Liverpool, East and West Midlands would all fit the bill as a location for investors because of that modest house prices, large student populations, strong employment factors for workers, prospects for workers, infrastructure development, and options for levelling up. And when we're saying levelling up, I mean Boris has been trying to push people like Goldman Sachs to Birmingham, the Bank of England to Leeds, and so on. Using £50,000, an overseas landlord would need to set around approximately £12,000 for fees, and then, or 6.5%, and then need to borrow £147,500 in order to purchase a four-bedroom property worth about £185,000. Hopefully that would give us about £850 per month rent. Rising with inflation, mortgage costs would be about £300 a month if it's on an interest-only basis, and we assume that we're going to buy a fixed lend at 2.5%. Again, that's a little bit rosy picture as things are going up. In the first year, with this rent and this sort of mortgage, the profit would be £4,638, rising to £6,225 in the final year. So an overall profit would be £54,000 plus. It's it's never that easy though. Most landlords do have void periods, time between one tenant leaving and the next arriving, and when renting doesn't come in. So to look at on the negative side, I've said that it'd be empty for 2 months each year. So therefore, the returns would be about a third lower. Profits would be £2,938 in the first year, reaching a total of £35,000 at the end of the decade. These profits could be increased by the underlying growth of the value of the property. The house price boom in the past year resulted in some great growth, but we're not going to see that again going forward. And even in normal times, property values do increase over the longer term, working on an assumption of house prices growing at just 2.1%, which is actually below the average, which has actually been just below 5% in the last decade. The example property 10 years later would be worth £229,000, a rise of £39,000. When it is factored in, it leaves the best case scenario landlord £93,185 back on their £50,000 stake. If there were 2 months of voids, the landlord would get £74,485. So how would a stocks or shares investment look better or worse? Okay, there's good things like there's no risk of void periods, there's no risk of problem tenants, there's no headaches at the end of the tenancy period, having to do houses up, and doing it from afar means that that can be a concern for a lot of people. So you need to have a proper manager in place. However, if we place your £50,000 in company stocks, which have historically performed at 5.3% per year over the past 60 years, then the £50,000 sum invested in this way would return £2,525 in the first year. By the end of 10 years, with compounding growth, our investor would have £81,833. The issue you have is what company stocks do you choose, and do you have the time to manage it? Many investors don't feel that. I once got on a plane in Hong Kong, got off in Sydney, and I'd lost £30,000 in stocks. It's a very difficult thing. So perhaps we went into there for gilts and bonds. Gilts and bonds have done 2.7% over the last 10 years, and would give us a return of 63,693. So that's not bad. Both scenarios have stockbroker charges of 0.25%. However, if you do use funds, then again you can be looking at a lot higher charges. And the issue you have with stocks and shares, and not being negative about that, is that you don't really know. It's not transparent. You could say, okay, well, I don't want any risk at all, so I'm going to put it all into cash. The best savings accounts we could find give you 0.6% interest, and over 10 years that would give you £53,000, which isn't really that great, is it? With inflation running at 5.1% this year, possibly 3% a year going forward, that's not even a touch inflation. The best investments go through the buy-to-let property. The landlord would have made £54,000 from rent, plus another £39,000 from the growth of property. That's a great scenario and gives you £93,185. By contrast, the best stock market scenario would return a profit of £31,833. Both these situations are before tax. Okay, both investors potentially would have capital gains tax in the future, and may have income tax, and maybe dividend tax. Those are things to work out. The best option depends completely on each individual's approach to investment. Property is profitable, but it is a hassle, and you need to get good people to do it. Investing in portfolios is fairly simple, but then you have to be knowledgeable to do it. Maintaining buy-to-let property requires the landlord's responsibility to fix it when things go wrong. The standard of the tenants can be the luck of the draw. You've got that EPC certification coming up on the horizon. So we do really need to look at all those sort of things when considering what to do. So at the end of the day, what is best? Equities are good, property is good, they're both very good. So therefore having a balanced approach is the right concept. As I mentioned, I got on a flight once going to Sydney from Hong Kong, and I had a stock market portfolio that was heavily invested in TMTs. And so I lost £30,000. At the same time, the first flight I ever bought in Hackney, two of the agents who were managing it for me at different times went bankrupt, taking the security bonds with them. So it can be tricky. It's just a case of spreading your eggs, but you have to be in it to win it. Simple as that. So I hope you enjoyed that. It's our first of the year. It's number 82, I think. Hopefully we'll get past 100, and we'll be talking again beginning next year about number 130 something. Please do subscribe and like. I appreciate your support. If you get the opportunity, go onto our YouTube channel, look at some of the other videos we've got out there. Thank you very much. Bye-bye.